Alright, in this video we are going to be covering Wyckoff Theory, which is a method of analysis created by this guy just here, Richard Wyckoff. Now, surprisingly for many of you, Wyckoff Theory is actually foundational to a lot of smart money trading today. So price action trading with supply and demand, liquidity and structure. A lot of this comes down to Wyckoff, which was created in the very early 1900s. It's a school of thought in trading that's built around market psychology. So we're looking at real price and considering the battle between buyers and sellers and how that's going to lead the market, rather than relying on things like indicators, trend lines, or anything like that. And if you understand Wyckoff Theory, you will ultimately understand the markets in a clearer light. And it's going to help you to become a better trader. So in this video, I'm going to teach you everything you need to know in a simplified manner from the very start as to what Wyckoff is, all the way through to how to trade it. So with that said, let's get into it. Now we need to start with the basics. And the most basic thing to explain is that Wyckoff is a theory built around supply and demand. So Richard Wyckoff believed that markets move dependent on the supply and the demand that's available in a market. Now to explain what those are, supply refers to units sold to the market or available units in a market, and demand refers to the willingness of buyers to purchase an asset. So if supply is high, that just means there are lots of units of a specific asset ready to go to market. If demand is high, it means that lots of people want to buy, okay? Now in a market where there is more supply and less demand, we get lower prices. In a market where there is more demand and less supply, we get higher prices. And you're going to see how all of this comes together to be tradable soon. But first of all, to go through this and really get it in your mind, I'm going to give you an example as to why this happens. Let's say you have 5 gold coins and there are 100 willing buyers who want your gold coins. This is a situation where you could set a high price for your coins because you know they're going to sell regardless of how much you want to charge. Why is this? Well, this is simply because supply is low. There are only 5 gold coins available and demand is high. There are 100 people who want to buy these gold coins. They are a scarce asset. The demand is high. Therefore, you can say, I want more for these coins, and someone there is likely willing to pay. So that instance where supply is low and demand is high creates price increases where price goes up. And now to flip this scenario, let's say 100 other traders brought some gold coins to market. Now, the coins are less scarce. People are only going to be willing to buy if you offer them a much lower price. So, now you have to sell your coins for a much lower price. And why is this? Well, it's because supply is now high. If 100 other traders have turned up with 5 gold coins each, there are now 500 coins, or maybe even more. And relative to that, the demand is now low. There are only 100 people here who want to buy gold coins. If there are 500 coins, suddenly no one is worried about getting one. There are loads. There's a 1:5 ratio of people to gold coins. So now they're not rare. And if you want to sell them, you're going to have to sell them at a considerably lower price because you have competition and you have a massive amount of supply coming into this market. In an instance where supply is high and demand is low, market prices depreciate, okay? And this is generally the backbone behind Wyckoff Theory. So now that we've explained that, Wyckoff suggests that markets move in a constant cycle of high supply and low demand, which creates price depreciation, and high demand, low supply, which creates price appreciation. Essentially, it is a battle between demand and supply, and that's why markets go up and down. And it's actually possible, based on Wyckoff cycles, to see this in real time so that you can get good trades. And under the Wyckoff Theory, 4 phases were created that we can use to track the supply and demand in a market. These cycle phases are accumulation, markup, distribution, and markdown. So we're going to take a look at each of these now, starting with accumulation. So accumulation is a phase where buyers are starting to accumulate orders. It's where demand is overpowering the market. And it looks like this. It's pretty much a sideways market that is followed by a drive to the upside. Markup is a phase where buyers take control of the market completely. It's price appreciation. And it looks like this. So following on from the accumulation, we have this phase of markup, which is a push to the upside or a profitable phase for buyers. It's clear bullish direction in a market. Now distribution is a phase where sellers are starting to distribute orders. It's the opposite of accumulation, and it's where supply is overpowering the market. It looks like this, a sideways market that's followed by a drive to the downside. And you probably guessed it now, the markdown phase is a phase where the sellers take control completely and price depreciation takes place. So it's the selling move or the down move after the distribution. So Wyckoff suggests the market only really moves in these 4 phases ever. This is an example as to what a market would look like under Wyckoff's theory. And now if you go and look at pretty much any chart, you'll see they actually do all look similar to this. We have phases of accumulation where buyers are collecting orders, and then phases of markup where buyers are taking the market higher because seller resistance has faded out. Then we get phases of distribution, which are sideways phases where sellers are retaking control. These will be followed by markdowns, which sell the market down lower, before continuations or reversals once again into accumulation. So essentially, buying and selling in a market is a battle. More aggressive buying than selling, meaning more demand than supply, creates accumulation and upward moves. More aggressive selling than buying, meaning more supply, less demand, creates distribution and downward moves in a market. And we use the Wyckoff phases of accumulation, distribution, markup, and markdown to execute on the right side of this buying and selling battle. So how exactly do we do it? Well, we do that through Wyckoff Schematics. This is how we actually visualize Wyckoff into a market and execute upon the analysis and theories we've suggested so far. Now this is what an accumulation phase looks like. Whether you're on a line chart or a candlestick chart, this is the standard accumulation that a trader will be looking for when trading Wyckoff. So to give you a brief explanation, because I know this looks very complex, basically this phase here is where sellers start to lose control and buyers step into the market. This phase here is where buyers are starting to cleanly take control of the market and the seller strength is fading away. This move here, called a spring, is the final attempt lower by sellers before buyers completely take control of this market and push it to the upside, where we get a sign of strength, which leads us into that phase of markup. So if we consider this from a logical market psychology perspective, what this schematic actually shows is the crossing point where sellers are losing control to buyers and buyers are taking control of this market, which will lead us into upwards price action. So the theory is really good, it's really interesting, and it actually is how the market moves. We have an insight into psychology by simply looking at the chart. But there is just one problem, and that is that, in my opinion, and the opinion of many others, it's just simply too complicated. I mean, look at this schematic. Are we really going to see this happening in real time and be able to execute upon it without getting lost? There is so much going on and so many mini moves that we have to keep track of if we want to accurately execute off of Wyckoff schematics. It's easy to get mixed up in the schematics. It's easy to buy too soon or too late and miss the move altogether. And ultimately, it's too hard to consistently execute. And quite simply too, it's just simply not necessary to get this complicated. It doesn't need to be this hard. Now, the concepts of Wyckoff can be utilized in a more simple fashion. So the question becomes, how do we combat this complexity? Well, we can do that by simplifying the Wyckoff schematics. So instead of viewing an accumulation like this, with all of the different confusing elements and so many different movements to keep on top of, we can look at an accumulation like this. This is, in essence, the same thing, but we don't have to keep track of all of these little tabs and different movements one by one. So to simplify this and go through the process of how this shows us an accumulation and what we should be looking for in the charts, we'll run through from start to finish, beginning with markdown. Now, a markdown, obviously being a downward move, is always going to come before a standard accumulation. Not reaccumulations, but we're going to discuss those later on. Your traditional accumulation pattern is going to begin with a markdown phase, which is some downward price action. Now, the next thing we want to see is a range. This range is the selling climax and the actual main accumulation phase in action. Now, what this shows us so far is, number one, the markdown is showing seller control. But number two, the selling climax and accumulation range is showing a pickup in control from buyers, where the buyers are actually matching the strength of the sellers. Now, this is very important because this is the first point in the market after the markdown phase where we're seeing buying and selling control at equal levels. So we don't have confirmation of strength just yet, but we are seeing that sellers are now failing to push the market lower, and they're actually in a battle and pretty even with the buyers. Now the next element, a very important one, is the spring. The spring is a final attempt to go lower from the sellers. It's a push down which takes out the low of the selling climax and accumulation range. The spring, in order to be confirmed, must be followed by the sign of strength, which is a push to the upside and a closure above the selling climax and accumulation range. What this spring and this sign of strength shows is a clear takeover of control from the buyers. So we see the sellers in control in Markdown, buyers stepping in through the selling climax and accumulation range. In the spring, we see a final push of strength from sellers, but the sign of strength actually shows the buyers completely taking control of all of the downside sellers have attempted and actually closing the market higher than the initial selling climax and accumulation range, which shows that the buyers have now shifted the trend and are in control of this market. Following on from the sign of strength, we would then see a pullback. That's what we would like to use as a buying point. This is going to give us the best possible entry for our positions. And then if we get the trade, we can run it through the markup, which is going to precede the accumulation. And that will be our profitable run into new highs. That's where the profit on a position from an accumulation schematic will come from. So to go through that, there are only 5 steps you need to see. Number 1 is the range created. So we want to see the market go from Markdown into a sideways range. Number 2, we want to see that range swept, the lows of that range taken out. Number 3, we want to see the range broken with a reversal back to the upside and a closure above the high after the sweep. Number 4, we want to see a pullback, which is where we want to buy with the best possible risk to reward. And then number 5 will lead us into the profitable markup, where we actually make the money from our accumulation trade. So that's the simplified outlook of Wyckoff. Now, this is the same for distribution as well. Instead of this confusing distribution schematic with all of these different elements and individual price moves to track, we can simplify it down to pretty much what we've just looked at, but flipped upside down, right? So looking at a distribution, we have our markup phase, our buying climax and distribution range, our sweep or spring, where the market takes out the high of that buying climax, our reversal into a closure beneath the range, which is our sign of weakness, pullback to sell, and then our profitable markdown. So we see here through markup, buying strength. Through the buying climax, we see sellers stepping in with equal power as the buyers. The spring shows the final attempt to go higher from buyers. The sign of weakness shows a total reversal in control into sellers, and then the selling point in Markdown is where we actually make the profits. Now, we need to go and look at these in some real examples on candle charts. So that is what we're going to do right now. Okay, so we're going to go through an example that is not perfect because in a market, setups are rarely perfect. I want to get you to build an eye for basically understanding the theory here so that you understand how to trade this even in situations where the market's fairly messy. We have our phase of Markdown. This is a clearly downtrending market, okay? More recently, as to where price is at this point, we have this sell-off down towards this low. Now, at this point, we start to slow down. The market moves into its sideways range. So when we can find this area, we have our Markdown phase, then we have our accumulation and kind of selling climax range, which is going to be, if we marked it out so far, we basically have our sell move and then our range as we covered in this simplified schematic. So now what would we want to see? Well, we would want to see a sweep. We would need to see the low of this range broken in order to validate the next step of the accumulation. So that is going to be this low just here, which is the low of the selling climax range, okay? So now if we jump the market forward, we see that we get a push down. At the moment, this can be seen as a sweep. It is not confirmed yet, okay? Because to confirm this, we would need to see pushes back above the range. So realistically, we'd want to see the market then return over this high, okay? Now, I would even say for this example, personally, we could realistically see just the break over this structural high, because this would actually change the trending structure and move us back to the upside. But to be the safest and the clearest, we're going to wait for the full significant break. Need to see if this sweep turns around into a bullish move. So what we've seen so far with this movement that we've started to get back in the right direction, Markdown, selling climax, we get our sweep, which is down to the current price areas, and then we want to see this movement here as our sign of strength. So to then continue on we basically have now this full move. Okay, we have the markdown, accumulation, sweep, break of structure showing sign of strength. Now, as we said, we want to see the market return on a pullback to a buy point so that we can get the best risk reward possible. Generally, after an accumulation, whether you look at it in the simplified way or in the standard Wyckoff schematic way, we are basically going to see a pullback down before you buy. If you buy at this high, your risk reward is going to be real bad if you put your stop loss under the low. And if you have your stop loss locally, the odds of that trade actually winning are pretty slim because the market likes to make pullbacks after it has made significant moves. Now, the way that I like to identify buy points is through supply and demand zones. Now, for this, of course, being a buy, it's going to be a demand zone. A demand zone is a consolidation before an upward move. So if we take a look here, this would be a demand zone. It's a sideways candle. Last candle before the impulse is what I use. Then we had this upward move. The market pulled back, retested this zone, creating a new demand zone, which would be realistically just around here. Once again, the last candle before the impulse. But as you can see, the market came back and retested this one as well. So this is what we call an efficient range. The market generally is not going to return to efficient ranges. And if the market does return to an efficient range, so if we were to get closures in this area, we would then likely take out the low. Okay. So I like to use the last imbalanced demand zone. This is pretty much how I would get into any trade I take, or supply zone for the case of a distribution if we were going the other way. And for the stop loss, we just want to clear some of the efficient range and make sure our stop is at least underneath. I would say this wick is a good one. You could go all the way underneath the low if you wanted to, but the concept here is if we were to close into this efficient range, the likelihood of the trade winning is then very, very slim. It's likely that the market will go all the way through. So we have to give some room for wicks, in case we wicked underneath like this, or we wicked a couple times, but we don't really have to leave room for significant closures because if the market was to close inside of here, we would accept fate. We would lose the trade and we'd rather just get out for a minimized loss. So buying from the buy point once the market's pulled back, great way to do that is just through demand zones. Stop loss, obviously under the low if it's possible. If the risk reward is too bad, put it somewhere underneath some of the recent wicks inside of an efficient range like this to make sure that you have clearance for any wicks that take place, but you're getting out with a loss without letting it get too big if the market closes into the efficient range. And then your target, of course, can just be up to, well, wherever. For this trade, we'll just put it at this wick just here. So now we have essentially our accumulation. We can see this is actually on a larger time horizon, also pretty much a bigger phase of accumulation as well with this market range. And then we'd have this break of structure there, pullback and buy. But as we've covered it, we've been looking at the more confined range of accumulation here, then the sweep, then the sign of strength. Now we're looking for our buy point, which is going to be down here. And then we will be looking for the phase of markup. Okay, so let's go ahead and play this one forward. You'll see that this, obviously, being a simplified manner, we don't have to consider every single element of Wyckoff here. We're not looking at all of the different labels. We're not tracking every single individual price move, but we are still following those same market cycle concepts of accumulation, distribution, markup, and markdown. Okay, so we've seen the market come through towards the target there, and that would be, in this instance, around a 5% trade at 1% risk. So the idea stands true, the concept stands true. We have used that market cycle theory of course, markdown, accumulation, spring, sign of strength, buy point, markup. But we've done it in a simplified way where all we need to look at is pretty much the flow of the market, where essentially we're looking at consolidation, break beneath, break above, closure, pullback, buy. Okay, so the simplified schematic led to this trade using those Wyckoff concepts. Now, following on from that trade, we can see the market moving into its next phase, which is going to be a style of distribution. Okay, so we see the markup phase has flatted out. So this is the markup when the market's got clear buying control. We flat out here into a phase of basically equal seller and buyer control. We get this small break, but this is not going to lead us into anything just yet because there hasn't been a sweep. Okay, we see the sweep formulating here, and then we see, well, not yet, but what we would ideally want to see would be the market come down under the range and then pull back to provide us with a selling opportunity. Okay, so let's take a look if this does pan out. All right, we see the market coming down here, pushing into the low. So we had our essentially first sign of weakness here. This is our sweep. So now we have the second two phases in action. We have the sweep phase, which is essentially here. And then we have what can be seen from a pure Wyckoff point of view, the first sign of weakness. Now, it can lead me to miss some trades, but personally, I won't get into trades if we don't get closures underneath a level. So these wicks show rejection. To me, it may work out. Sometimes the trades do work out, but that's something I personally wouldn't be catching unless we were to get another close beneath and then pull back. But of course, we'll just see if that does take place. So in this instance, we've had a sell-off and we may not get the pullback. It looks like we may potentially not be getting the pullback here. So for me, this opportunity of distribution would have been missed, but still you can see highlighted how this continues playing out in the market. Now, on a smaller time frame perspective as to what we're looking at down here now, we can see that maybe the market is now moving into another phase of accumulation. We have Markdown, then we have the selling climax range here. We have had a spring down here. We've now seen the market coming back up, pushing back above and closing back above some of the accumulation that we saw. So ideally then we would want to see a pullback and then we would see a continuation higher, would be the general idea we'd look for in this instance, okay? There we go. You can see that as well, the buy point we spoke about of demand zones here. That would be our demand zone. So your buy point would be on that demand zone. Your stop loss underneath the wicks. So those are the wicks. You could even put it under the low on this one, to be honest, because the risk reward is better. And then your target would just be, you know, wherever you may want it to go. We'll just use this swing high as an example. So just about there. So there you go. You can just see actually a natural formation. We have kind of a messy accumulation that still makes all of the characteristics of a simplified Wyckoff schematic. We have a distribution which provides all of those concepts as well, except for me, unfortunately, this wouldn't be a trade I'd be able to get into because that doesn't fit my rules. And then we have this accumulation, which is a much smaller time horizon accumulation, but still works in exactly the same way. And that's another note about this, because accumulation, distribution, and Wyckoff theory is built around market psychology and built around price action, it really doesn't matter what time frame you trade, okay? If we look at this from a 30-minute perspective, we have a nice solid accumulation. If we look at those other ones on the hourly 4-hour perspective, we have solid accumulation distribution. So it doesn't matter whether you're trading high or low time frames, this concept can continue to clearly pan out. So with the new information you have, you can eliminate the confusion and simplify your Wyckoff theory. Now, if you want help building this into a system, I have a free trading course in the description. I'm going to help you to build a trading strategy to simplify trading, improve your results, and ultimately find success. There's a link at the top of the description for this. It's completely free. I'm also going to send you lessons via email if you want them as well. And just so you know it's worth your time, these are some results from literally just the past week or two from students that have learned from me. So make sure you do that. If you really don't want to do that though, watch this video next. It's going to follow on from this one and give you some solid value. So thanks for watching. I'll see you in the next video.